Welcome to Thoughtful Money. I'm Thoughtful Money founder and your usual host, Adam Taggart, here, welcoming you back for take two of today's interview with Stephanie Pomboy. Stephanie, how are you?
I'm better. Thank you so much, Adam. And thank you for your patience with my apparent litany of technology problems today.
You talk about kind of the technology gods not liking you very much, and I think they took this as an opportunity to flex their muscles and show you how much they like to disrupt your life. But look, Murphy's Law, what can go wrong will go wrong. We can't control that, but we can control how we react. So we're soldiering through. If you watched the earlier and aborted take one of this, welcome back. This one is not live. It's being recorded here just between Stephanie and I, so we won't be taking any Q&A now. But as Stephanie has very generously agreed to do, when she comes on next in 2 weeks, we might run a little bit late, but we'll certainly take a lot more questions from the audience. So Stephanie, thank you again for soldiering through all this. We had two interrupted attempts by technology to try to get you to give your latest thoughts on inflation. And just to summarize very quickly for folks, you had said, look, the markets took last week's kind of only mildly softer, CPI data as a reasons to just unleash the animal spirits. And all of a sudden, folks aren't nearly as worried about as inflation, as sticky inflation as they were. You think that may be a mistake. Why?
Yeah, so thank you. Well, first off, the headline number at 4/10 annualizes to 4.8%. That's 2 full percentage points above where it was running in the 12 months prior. It's also 2.8 percentage points above the Fed's target. So that hardly struck me as cause for celebration. The real reason, obviously, the markets were excited was the core number, which was a little softer. But I thought it was kind of interesting that on the same day the market celebrated this slightly cooler core inflation print, as if they live in a world where no one needs food or energy, oil prices hit $80 a barrel. So, whatever cooling there was in the energy component obviously is temporary. Admittedly, oil prices are back down to like $77 a barrel now, but I think it's noteworthy that a lot of smart people have been forecasting that oil prices would head lower, and they have refused to do so despite a global slowdown in economic activity. And on the same day that this CPI number came out, a ceasefire deal announced in Gaza, and then a new administration that comes in and promises to end the war in the Ukraine. So all those things would seem to be reasons to send energy prices lower. And in fact, they are trending in the other direction. So long story short, I think that the markets were wildly amiss in terms of celebrating this or spiking the ball in the end zone, that inflation has been vanquished and now the Fed has free reign to continue on its way with rate cuts. And so I anticipate that the massive rally we saw in bond yields on this CPI number and the attendant rise in equity prices associated with it will probably reverse in the days and weeks to come as we see those higher energy prices start to creep into the gasoline price, and eventually that will be reflected in the inflation numbers going forward. It also bears note that if you overlay the CPI chart with the CPI, you overlay the overall CPI chart with oil prices, or even the core number with oil prices affect everything. So even if you're stripping energy from the CPI, higher oil prices will drive up the price of everything else. We know that. And yet, for some reason, we have this practice of assuming, well, it's just oil, therefore it doesn't matter. Outside of labor, it's the number one input into everything we consume. So,
Hey, Steph, in that, I don't have that overlaid chart, but when you do look at it, are oil prices the leading indicator between the two?
yes, in fact,
Okay.
if it's okay, I'll send you that chart that I have, and it lags, the energy component to show that it's about a 6 month, 9 month lag between energy prices and when they actually pass through into the CPI. So that's, it's one thing that people don't really focus on because we become so accustomed to excluding the volatile food and energy components. But again, even if you're not talking about gasoline that you're putting in your tank or using to heat your home, you buy a box of cereal and they're 50% of the cost of the box of cereal. That's my number, but a large percentage of the cost of the box that you purchase is energy prices, whether it be the energy to actually, till the fields and then, create the product and then put it in the package, and the lining of the box, that plastic sleeve has, oil in it, and then getting it to the store, and et cetera, and et cetera, so on and so forth. So long-winded way of saying.
just to provide validation of that, I mean, here's a headline yesterday from the Wall Street Journal: food prices are rising again, right?
Yes. Yeah.
So there are other factors going in there. Here they're mentioning things like bird flu, bad weather, and whatnot, but obviously increase in energy prices are part of that. So, as you said, everybody can cheer the softening in CPI as long as they all believe we live in a world that energy and food is unnecessary.
Yeah, absolutely. And I guess I would also point out that in that food thing, food prices hit a record high, not surprisingly. And then there was someone who's forecasting that egg prices are going to go up another 20% over the rest of the year. So again, this celebration seemed wildly premature. But ultimately, what it really comes down to is not the whether inflation's running at 4 or 3 or 2. It's where it's running relative to the consumer's income. And that continues to be a major issue that has not been overcome. In the latest Michigan sentiment survey, the number of people who expect that their income will actually outpace inflation this year fell to the lowest since the great financial crisis. So they're not optimistic that they're going to reap real income gains. And that presumably will serve to dampen their spending. And that's one thing, we did see the retail sales number a couple days later. And there again, so we had a 0.4 increase in retail sales. Well, that's exactly equal to what inflation was up. So if you buy the government's accounting of inflation, you're saying people didn't increase their spending at all in that month. I mean, they bought the same number of units. I'm sorry, let me rephrase that. They bought the same amount of stuff. They just kept
it just costs more.
Yeah, exactly. Kept up with the cost of everything going up. So that's another moving part to this drama, is the assumption that the consumer now is going to start to accelerate his spending. And, that rests on the idea that they're going to put the spending cart before the income horse. And they had been doing that. They had been running up credit card debt, but in the latest numbers we got on that, credit card borrowing collapsed. Huge decline in revolving credit in the latest month. So none of this adds up, to ratify the narrative that the markets seem to be running with right now.
Right. And on that last point, could you just clarify for folks? Some people might think, oh, well, consumers are taking out less debt. They're becoming more prudent. That's a good thing. Shouldn't we be cheering that? I believe you probably think they're not taking on more debt because they can't. They would like to, but they're beginning to struggle under the debt that they're currently under. Is that the case, or do you have a different explanation?
Yeah, no. Well, two things. Number one would presume that no one was borrowing on their credit card at 23% interest rates because they wanted to. You have to assume that people who are borrowing at that kind of exorbitant rate are doing so because they have no choice. And that kind of conclusion is sort of bolstered by what we've seen in the trend in multiple job holders and how people have had to work 2 and 3 jobs just to make ends meet. But also, when you compare what's happening with credit card borrowing versus the real retail sales activity that I referenced earlier, when people are slowing their unit spend and increasing their credit card borrowing, that's obviously a real warning sign. It would be one thing if they were increasing credit card borrowing and spending more or taking vacations, or or if confidence was soaring at the same time. But these are not things that we're seeing right now. Quite the contrary.
Yeah, and let me just ask about that for a moment. So we were going when we take one of this discussion earlier today, we were going to cut it a bit short anyways because Murphy's Law intervening again when we initially scheduled today's recording, we didn't realize it fell right on the inauguration, right? So we now have a new president versus when you and I talked a few hours ago, and we've seen a lot of confidence spike because of the new administration. This has been post-election. People think, okay, new administration that's very business friendly, et cetera. So we've seen like business confidence spike. We've seen consumer confidence in the markets spike in terms of their expectations of future market returns, but that stands in stark contrast to their expectations for their own prospects. So we see this real divergence where people are basically saying, man, I think I'm more worried about my job. I'm more worried about how much money I'm going to be able to save going forward and whatnot. But I'm super excited about stocks. And there seems to be a dichotomy there. Would love to have you comment on it. But they're getting super excited about stocks after the market has had two surprise back-to-back 20% plus years, right? So expecting that kind of momentum to continue is already statistically very low. And at the end of the day, a lot of consumers really don't own that many stocks. It's the stocks are over-owned by the very wealthy. So are we seeing, kind of some contrary and maybe almost sort of magical thinking going on right now by the consumer?
Well, I think this really brings me back to 2016 when Trump won the first time. And you did see at that point, and I think we may have talked about this in prior conversations, we were coming off of a really bad corporate credit crisis that was weighing on corporate profits and hiring, and was hitting, obviously, consumers and confidence, et cetera. And then when Trump won and started implementing these pro-growth policies and the tax cuts and whatnot, the economy basically turned on a dime. So I think Wall Street's analysis has been, well, we just replay the tape to 2016, and if he implements the same policies, we'll get the same outcome. The problem is that valuations in 2016 were nowhere near where they are today. In fact, I think for the better part of 18 months going up to the election in November of 16, the S&P had gone nowhere. It had basically been dead money for 18 months. I mean, you couldn't come up with a more stark difference from today, where the markets have basically been flying, as you said. So, even if you believe that all these policies will be enacted in the form that has been described and everything will be smooth sailing, at what price should assets deserve to trade? I mean, has this all been fully discounted at this point? And I would suggest it has been, and then some, because if anything, it's pretty clear already that it's not going to be as easy to get these programs implemented as Wall Street has imagined. And we saw that, in this whole speaker vote, et cetera. I mean, it seems like the Republicans aren't unified, and that could end up being a little bit of a problem. And now they're debating whether to have the tax cuts as part of one big, beautiful bill or have two separate bills, in which case, Wall Street's going to be sit there tapping its fingers on the table, waiting for the tax cuts through months of deliberation, which I would guess would be fairly nerve-wracking. So to me, it feels like there's been this anticipation of this perfect sort of nirvana scenario from valuations that were already extremely stretched, leaving basically no margin for error in a world where I think the prospect of error is extremely high. But that's me. I tend to be fairly cynical.
Okay, well, on just to tap into that potential cynicism, but if you don't feel cynical on this, please let me know. For those who are excited by the stated policy strategy of the incoming administration, what would your advice to them be? and kind of where I'm going with this question is let's give the Trump administration the benefit of the doubt. Let's say that it's successful in achieving its major economic policy goals over the next 4 years. Um, Assuming it is successful, do you think it can get there just by, incremental progress, that every step is a step higher, or will some of these things be disruptive at first and potentially so disruptive that they get in the way of the market's current everything is awesome always and forever narrative, and that we may have to see some either repricing of financial assets from their current euphoric highs, or that tariffs or whatever displacing millions of illegal workers that, yes, are here illegally, but they are working and they're working in core parts of the economy. Might we have some economic disruption that actually impacts economic growth in the near term?
Yeah, absolutely. Well, let me start by saying that I am excited about the policies of this administration, and I really share the optimism that they'll be able to be implemented in the manner in which they've been outlined. So I share all of that. I'm not in any way here to say, this is harebrained stuff, and I hope it doesn't succeed. Quite the contrary. I'm 100% on board with almost all of the policy proposals. That said, I do think that these policies are not without some negative consequence that we need to contemplate, at least in the near term. And I would say the most obvious is that if you're talking about sweeping deregulation, tax cuts, and these real pro-growth policies that are going to stimulate growth, you're talking about an environment where, as we just discussed, we have inflation above the Fed's target by almost 3 full percentage points on the current run rate. That's probably going to continue to be moving out of reach rather than toward them if growth is accelerating. And that would suggest an environment where the level of interest rates will be higher for longer. And to my mind, that is the single biggest risk to the markets that people aren't focused on. And I know I'm a broken record, and we've talked about this a million times before, but the impact of higher for longer interest rates is so massive, so widespread, and negative for corporate profits, for credit quality, for basically everything. Who knows what happens in the financial sector? We have this massive shadow banking system, private credit, private debt, that relies on mountains of leverage, and we have no visibility into what's going on there. But presumably the credit quality deterioration we're seeing in the public markets is every bit as bad, if not worse, in that segment. With potential repercussions that are unknowable, but surely not good. So I think that's the biggest concern I have, is that we end up having pro-growth policies that are bullish for the economy, but end up being very negative for financial assets because they sustain higher interest rates on an economy and financial system that's just so incredibly levered. That becomes an issue. So I have to separate my optimism about the economy from what I view as a major headwind to the markets. But as relates to your points about the cost of deporting illegal aliens. Obviously, I think about my landscaper here. Everyone who works for him is an illegal alien. And I know that if he has to hire people who are documented, my monthly landscape bill is going to go up a lot because he's going to have to pay these people a lot more money. And not to mention doing all kinds of additional paperwork, I'm sure. So and that too will be inflationary in the near term. In the long run, sure, it'll be great because it'll get more people who maybe have given up on looking for work in off the sidelines, and help boost economic activity organically here in the country. But there are a lot of near-term uh, costs to implementing these changes.
All right, let me ask this question. I can't recall if I've asked it of you yet, but I've asked it of many guests. And I know you're not a political analyst, and I know that you don't know Trump personally, but a lot of people remember Trump's first administration, and he would use the stock market as more or less of a scorecard.
Yeah.
And so I think there's an expectation amongst some that, well, they'll never let the stock market correct because, Trump's ego won't allow that, or that's the benchmark that he has the world judge his performance or whatnot. Um, I'm going to munge a few questions into one. One, do you think that's the case? Or do you think, kind of the standard playbook is you get in office, you kind of hope and kind of help markets kind of correct because it brings things down to a more sustainable baseline. You've still got the goodwill that you're riding in on. You can blame it all on the previous guy. So, a lot of people I've talked to, and this was my initial advice when I thought of this, is, Trump really should be, if I were advising him, I'd be saying, hey, start the messaging now. Now that you're in, the mess was way worse than you thought it was. Tell everybody it's a great thing you're here and you've got such a great plan, but it's going to take a while to get to the promised land. And we're going to have to soldier through this together, and we're all going to have to tighten our belts and whatnot. Do you think, which one do you think Trump's going to adopt more? The latter, or is it going to be back to Trump one of just, hey, do everything we, calling every time the market dips, he's calling up Jerome Powell on the phone and banging on for QE or lower rates or whatever?
Well, you put me in the impossible position of separating what Trump should do from what he will do.
Yeah, and I understand I'm asking you to guess on this. This is just speculation.
And again, I'm not a political analyst, and as you said, I don't know the man. But as intellectually smart as as smart as it would be for him to message the way you described, and to let the markets, cleanse themselves of the excesses, and then hope that in the second half of his term there's a rebound and everything ends on a really spectacular note that becomes his legacy. I don't have any great confidence that that will be his reaction to a decline in equity prices. I think that, as you said, he does view that as a barometer of the health of the economy. And while I think it would be easy for him to pin the blame on the prior administration and say, we inherited this mess and we're going to have to do some serious belt tightening and it's going to be hard. I just don't know that that's really in his DNA. So I guess and I do remember, of course, in 2018, where he was threatening to fire Powell and, saying we need lower interest rates, we need lower interest rates. And eventually he called Powell into his office, and the next thing you know, the Fed pivots. Could that happen again? I wouldn't rule it out. Obviously, my heart would be in the scenario that you described, where we actually take the pain and put on our big boy pants and actually recognize that we're long overdue for this, and it would be better to get it out of the way quickly. And also, if we get into a situation where we're constantly going back to the Federal Reserve to bail out the stock market, it just makes ultimately the day of reckoning far worse. I mean, at this point, how many times have we kicked the can down the road already?
Right. Well, let me ask you this, Stephanie, and then we'll start wrapping up here, because again, I promised you that we would let you tell the full inflation story, but then everything else we can save for your next appearance here on your new biweekly show. Inflation is proving sticky. You've just shared your thoughts with us that you think Wall Street is being overly optimistic here. Do you see where do you see inflation going from here? Not just even in the short term, but kind of in the next couple of years. Jerome Powell is definitely telling a story of it's taking a little bit longer than we want, but all the data is showing us that the trends are in the right direction, and we're just going to let time take its course here. We've had some other folks on this channel. Lacey Hunt will be back on in just 2 weeks to give us his latest update, but he looks at his standard metrics, largely how the money supply shrank, back over the past current years. And he just says you can't get away with a free lunch from that. That gets the cost of that is the economy must slow, and he thinks that disinflation will eventually win out. We've got guys like Lance Roberts and his partner Mike Leibowitz, who have done a ton of math on this channel, so I won't go through it all, but they're basically saying if you look at kind of the standard correlations, inflation is going to have to come down as well. Now, that said, there's a lot of other people saying, no, I think inflation is going to be stickier. It's going to keep yields higher, as you said earlier. And they see more of like a, potential 1970s style where inflation goes up and then the Fed has to go back into inflation fighting mode and it comes down, but then maybe it rises again. Do you have a particular trajectory that you're expecting here around inflation?
Well, I guess I'd make two quick comments. The first is in the very short term, and maybe this is one of the things that's gotten Wall Street excited, the math year on year is such that the headline CPI should move lower through April. So we've got 4 months where
and this is base effects where you're comparing it to, yeah,
because we're comparing it to very hot inflation readings this time a year ago. Year on year, you'll look for some tailing down in the headline inflation numbers, which is, of course, irrelevant in the big scheme of things to real consumers, et cetera. But that's just one thing to acknowledge at the outset. So if people see the CPI numbers starting to cool, and they don't say, oh, Stephanie, you're such an idiot, you thought it was going to go up. I'm talking about sort of in the broader sweep of things, the lagged effect of higher energy prices. But I think that from my standpoint, I have a real weakness, as you know, for Lacey's argument about the massive amount of debt and how deflationary that, coupled with our demographic situation, is in a secular framework. The question is the cyclical side of that, because within a secular downturn in inflation, you can have cyclical ebbs and flows, obviously. And we were clearly in a situation where cyclically inflation was picking up. Now it's in a cooling phase. Will it pick back up again? I think there's reasons to believe, mostly because I see this shift to commodities inflation that will push through the CPI numbers. But as we've also talked about at length, my sense is that we're reaching the point where that kind of inflation can't continue to be passed along endlessly to consumers who just don't have the wherewithal to absorb it. So I do see inflation as more of a PPI, an input inflation phenomenon. I think there are limits to how much farther the CPI consumer prices can rise before it just can't rise any farther. Consumers can't keep up. But ultimately, my sense, and one of the reasons why I've had a weakness for Lacey's view, isn't just the debt and demographics, but the risks that I talked about, that if you have this situation where we're talking about a market that's succeeding to higher interest rates for a longer period of time, and that takes some air out of the stock market and risk assets in general, that will have a real disinflationary impact on the headline readings. I mean, remember back in 2000, people forget this, but just before the Great Recession in 2007, I think December 2007, inflation was 5.6%. CPI was 5.6% year on year. I mean, we think that inflation was 2 for our whole lifetimes, but it was actually 5.6. A year later, it was -2. So that's how quickly the collapse in equity prices and risk assets was able to feed through to goods and services inflation. Just people, that reverse wealth effect is so profound, whether it's psychological or actual, that you could see some cooling of inflation there. But I think between now and that point where we hit the break point, I would expect to see inflation just be stubborn. I mean, I'm not necessarily even saying it's going to go much higher, but if it refuses to go down, that's a problem for the Fed.
Right. Because it keeps things higher for longer, both in terms of prices and more importantly, probably even bond yields. Okay, so
absolutely.
So let me just ask this on inflation, and then we'll start to land the plane here. So the biggest component of CPI is shelter, right? I think it's like 40% or so ish. So in many ways, as
Mhm.
shelter prices go, the CPI goes. And it's taken a lot longer for that data to start coming down, that component to start coming down. And there are a whole bunch of reasons for that, but home prices tend to be, so shelter inputs to CPI tend to be some of the most lagging inputs into the equation.
Mhm. Yeah.
So some people that are pro inflation getting tamed just say, hey, look, that trend has started, and sure, maybe other prices might go up, any given month along the way. But if you've got housing kind of cooling, that's just going to be dragging that whole thing down with it. What are your thoughts on the shelter component?
Well, I agree with that. I think it has been a factor in pulling down the inflation numbers. And then we're reaching a point where we're going to get to that inflection where, in the home prices did start to come down and then you turned back up again. So I think we're reaching the point where, as unsatisfying as the decline has been, its impact, it may have run its course already and we're starting to move higher again. But the other part of it is, even if we've got a little more downside to come, with interest rates higher for longer, you're just locking up all that inventory still. The
Mhm.
market will remain frozen. So you won't have that clearing that actually I would have thought perversely that lower interest rates would have led to lower home prices because you finally would have been able to move and you would have seen a lot more supply on the market. So my sense is that it's it's a little bit of a push pull situation, and I think that those higher rates could really keep the market frozen for a while and not give us that satisfying decline in the shelter component that everyone's looking for.
Okay. Well, look, I've got a ton of additional related threads that I'd love to pull with you, but we're just going to save those for your appearance here in 2 weeks, because I promised you I'd let you get the inflation stuff done and then let you get back onto your life here. But lots and lots of questions about market direction and things like that. I do maybe just want to make sure I'm understanding your general view correctly, so that when you're back on in 2 weeks, we can start there, which is. You say that you think inflation's going to be, I sort of hear you say, look, folks, don't discount inflation. It's probably going to be around for longer than you would like. Um, but that's in the things that you need to live your life.
Yeah.
Sadly, prices are going to be high. In terms of asset prices, I believe you think that the risks, at least this year, I'm not saying next week, but this year, the risks are much more to the downside. You could call that disinflation in financial asset prices. Am I capturing your outlook correctly there?
Absolutely. Yeah. I definitely think that will be the case, that inflation in the economy will beget disinflation in financial assets. And, we started to see the beginnings of that last year, with commodities, or gold in particular, outperforming the stock market. So it's clear that you already have an environment where, in real terms, paper assets are losing ground. So now the question is, will we reach a point where in nominal terms they start to lose ground? And I think they may, but for sure, in real terms, we'll have another rough year, I would expect. So, and you
Okay.
don't need to apologize for me for my time. I'm the one who needs to apologize to you for these technology interruptions. And next week, in 2 weeks, I'll be coming to you via my new computer, hopefully. Oh my gosh.
Well, look, you've been such a great sport, Stephanie, and that's so visible to everybody. They can tell right now you're actually on your iPad. So when your
Yeah.
computer died earlier today, you went and jerry-rigged this current solution. It's been fun to see a different part of your house. Everybody's so used to your well accoutred
Oh,
office there, but now they get to see another part of your house. And I
yeah.
believe
I'll show you.
Wilhelmina must. She,
She's right here. I don't know if you can see her down here.
There we go, because I could definitely hear her a bit during during the
she,
discussion.
she saw me come in here and settle down, and she had to be part of the program. So There
All
you
right. Well, look,
go.
thank you so much for finding a way to,
Yeah.
Rube Goldberg-esque pipe in here and deliver the message that folks were so excited to get. So anyways, thanks so much, Stephanie. It's been wonderful. Everybody watching, set your calendars for next Monday, or sorry, 2 Mondays from now. As a reminder, Stephanie's new show here, this is the second one. Uh, it releases every second Monday at 11 a.m. Eastern. And we've said if these things go well, we'll make this a regular occurrence going forward. I hope today's troubles don't get in the way of it going well for you, Stephanie, because I know folks have really enjoyed even the aborted attempt we had before, and I know they're really going to like this. So hopefully you hang in there, and hopefully better days will be ahead here.
Well, I'm just glad that we agreed you would hold my hand until I got my bearings on this, because today would have been an unmitigated disaster if you got me there to step in. So, oh my gosh.
It's all good. Well, folks, please show Stephanie your appreciation for soldiering through here by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. As always, if you want some help in figuring out how to position your portfolio for what may lie ahead, especially if the things that Stephanie thinks are probable indeed do happen. If you want some help from that, you can get it from a good professional financial advisor. If you don't have one of your own, just go to thoughtfulmoney.com, fill out the short form there to be connected to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week after week, week in and week out. And they'll be happy to help you in any way they can. And as a reminder, these consultations are totally free. There's no commitments. It's just a free public service they offer. Stephanie, as usual, so wonderful to have you here. I resisted the urge to ask you more specifically about the policies of the new administration. And the reason why is because there are something like 200 executive orders,
Yes,
I think, getting signed as we speak, right? So I'd like to give you the chance to let the dust settle, read through them and whatnot. But next time you're on, it'd be great to see if there are any particular ones in there that you think will be particularly impactful for the economy within the coming year, either on the positive side or the negative side, if that's okay.
Yeah, absolutely. I look forward to it.
All right. Well, Steph, as always, so fun, so wonderful to talk to you again. Thanks for rolling with all the punches here. Everybody else, thanks so much for watching.
Thanks, Adam.
In 2025, Arcadia Economics' Chris Marcus notes the silver market faces structural shifts amid rising deficits. Silver has surged 88% since early 2024, climbing above $40 for only the third time in history, according to a report by Arcadia Economics. Industrial demand reached a record 680.5 million ounces in 2024, while retail selling and supply constraints highlight growing imbalances. Institutional flows, new technologies such as Samsung's silver heavy batteries, and fresh central bank interest in Russia, coming from Russia, Saudi Arabia, and the US. I wouldn't say that we're central bank buying yet, but central authorities are buying silver now. We're going to be hoarding silver now. They all suggest silver's strategic role is expanding rapidly.
As deficits widen, significant structural shifts in the silver market have been noted. Silver has risen 88% since the beginning of 2024 and is now above $40 for just the third time. In 2024, industrial utilization reached a record 680.5 million ounces, propelled by innovations such as Samsung's silver-rich batteries. Although there are obvious mismatches in retail sales and supply, institutional inflows and escalating interest from Russian, Saudi, and American authorities indicate that silver's strategic significance is rapidly increasing. Vince Lancy, a veteran trader, metals analyst, and founder of Echo Bay Partners, highlights an extensive analysis of silver's prospects for 2025 published by Chris Marcus of Arcadia Economics, highlighting the metal's significance for years to come. Samsung's silver-heavy batteries are a major emphasis. The estimated demand for silver is so high that a logarithmic chart is needed to explain it. Marcus's enthusiasm and thorough analysis are evident in the report, which is a great tool for anyone interested in silver. The focus is now on Trump's new Executive Order 232, which raises concerns about the future of policy because it noticeably ignored silver despite previous references. Powell has essentially deprioritized rigorous inflation targeting, So rate cuts are more dependent on job losses than inflation, even though upcoming data like the CPI and PPI may influence markets. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
Silver's future looks very bright, as well as the unlock post, which is linked in there for Chris Marcus's Arcadia Economics. So, personal professional comment now. Chris Marcus published a mammoth, ambitious report this weekend on silver's outlook for the rest of 2025. While the report covers that time frame, makes it like a timepiece, its implications extend far beyond that, making this a must-read for anyone who wants to understand the likely path of silver ahead. One section worth highlighting is on the Samsung batteries. Now, we had read this and we know about this, but we had never looked at the side-by-side, how much silver was used, how much silver could be used. We even tried to create a graphic for it, but couldn't make it fit. That's how earth-shatteringly large silver's role would be in these new batteries. We put the graphic in. The first graphic was, this is how much silver is used versus this is how much silver will be used. And it was ridiculous. So I had to make a log normal chart. And even then, it's ridiculous. Anyway, Chris was kind enough in the credits to thank me for my contributions. And I'm glad to have played even a small role in what is clearly a labor of love. If you know Chris, you know his passion for silver, combine that passion with detailed industrial analysis, and the result is pretty impressive. The full report is included in the post, and we would recommend you visit Arcadia to take a look at that as well. Moving on. Related post, Hartnett, we mentioned that. Sunday CFTC analysis, that was a really good one. It was a fun one for me, too. I got 2 hours of that recorded, and very lively interaction, as well as some good questions. And plus the guys got me to talk more about my childhood trading. Mini pod, macro discretionary, Goldman, gold price near 5,000 and Fed damage. It's starting to look more realistic to me than it sounds. Coming soon tomorrow, probably, we're going to have a breakdown and analysis of Trump's executive order 232 signed this weekend. We have a couple calls into people that we're trying to get some more information back on. We understand the implications for gold. People have been talking about it. We actually have some analysis from a Goldman trading desk, institutional stuff, that'll break down the gold for us. We're going to look at that a little bit closer today. And what we're focusing on now is getting data on what was not said about silver. Silver was not mentioned. And you could say, oh, well, it's just, who cares, right? No, silver was mentioned when 232 was first discussed, but it wasn't mentioned in the signing of the executive order. So what does that tell you? I don't know. We're going to find out. Data on deck, CPI and PPI. Now, those are important numbers. They're always important numbers, and they're going to move the market. But I'm telling you, they're not important unless they're incredibly high for Powell's decision to cut. Okay? The decision to cut is based on the economics. Are we firing people or not? Not the inflation. He has already raised the inflation target by abandoning the FAIT. He has basically said, I can't focus on inflation anymore. He blamed it on the FAIT, tied it to the goat, released it into the desert. The scapegoat is out there. It's done.
Vince Lancy clarifies that unless inflation is exceptionally high, Powell's rate cut plans are unaffected by short-term movements in gold based on CPI or PPI data. Intraday charts and stringent risk management, setting tight stops, taking partial profits, and letting the remainder run if momentum holds, are their main tools for trading. At the moment, silver provides little clarity but may be creating a bull flag, while gold appears bullish above critical levels. Instead of chasing moves, the emphasis is on risk management and discipline. Let's dive into the interview.
Because look, if you see gold drop $100 on CPI or PPI, check in. Why? It's not going to change his plans unless it's ridiculously high. All right, let's move to the markets. As I said, you don't want to buy gold now because of this symbol. If you're buying gold, you're buying it for a completely different reason. Okay. And I'll tell you what the reason is for me. The reason is I'll take this analysis, this system that I use, and I'll break it into an hourly chart. And I'll say my bias is bullish because of this chart. And then I'll put it into an hourly chart and I'll look for an entry point that tells me acceleration is due. That's the weekly in gold, weekly in silver. Weekly in silver's marching along. The daily in silver really was it was the cue there. Let me go to a couple other systems. Okay, so I'm doing my intraday analysis right now, right here for you. There's an algo buying the market. It's not safe to buy it below 36.13 for the next 2 hours. So I'm long. I'm not buying it right now, but I'm long right here, and I'll sell it on a stop loss below 36.13. And how much am I risking? $5. I'll sell it at 36.28. That's it. Risk 5 to make 10. Go with the flow. Stop yourself out and move on. Now, if the market gets down here and breaks this, I back off. I reset. As long as it's above these lines, that's poly market, by the way. Poly trends, not poly market. Poly market's the gambling site. I think these lines are pretty important for the day. And even if they weren't here, I'll take it out so you can see it a little bit more visually. This is a line going. This is a typical line that I would draw. I was like, all right, this is where it paused. This is where it got rejected. This is where it broke through. As long as it holds in this area here, 35.98 area, then I would look for another reason to get long. If it breaks 35.98, I start looking for reasons to get short. Intraday. Okay. So if this never breaks, so I just bought it right here, right? In our hypothetical, I bought it right here. And I don't get stopped at and it goes to 35.28. Should I take my profits at 36.28? Well, yes, I risked one to make two, right? No, I'm not going to do that today because I'm already very bias bullish. I'll sell half. I'll let the half run for the rest of the day, for the rest of the week, for the rest of the month if I have to. And that's the idea. You get a good entry, you put a tight stop in, and you trail your stop higher. That's the way to look at it. Let's see what silver offers. It's not rocket science. It's just being disciplined with your risk. Silver offers me no insight right now. No insight, at least on these things that I look at. Let's see what Poly has. I'm doing this for the chat, guys. I know you guys are very looking at this very much. All right, so Poly gives us a level to not be bullish above for the rest of the day. 41.18, which is pretty close. So no Bollinger Band analysis here. You ready? You buy it here with 41.18 as your stop. If it goes below 41.18, you're neutral. If it goes below 40.91, you're bearish. The rest of the day, intraday stuff. This doesn't affect my silver physical. Doesn't affect anything. I'm just trading. It's, how's the movie go? It's just money, right? And silver's not just money. Silver daily, that's great. All right, so this is shaping up like a I can't believe I'm saying this. This is shaping up like a bull flag.
Silver's role as a strategic asset is rapidly expanding, supported by record industrial demand, new technologies, and growing institutional interest, even as policy signals remain uncertain. Gold continues to show strength, while silver may be setting up for its next move. For investors, the key lies not in chasing short-term swings but in understanding the bigger structural shifts and managing risk with discipline. How might Trump's Executive Order 232 affect silver's future role if it continues to be excluded from policy discussions? Could Samsung's silver-heavy battery technology accelerate silver shortages faster than markets expect? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
Gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. Gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just get back to the old highs. So massive inflows there, but it's a major shift. Key thing to think about gold here is here's a key risk I think for gold for then. So I think gold has a lot more room to the upside. Significant correction, it might get near 3,300. But 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over the year. I still expect gold to be one of the best performing major assets this year.
Gold is holding around $3,653 an ounce, with $3,500 as key support and $4,000 as the next resistance. ETF inflows are strong, showing a major market shift. While a pullback toward $3,300 is possible, the bigger picture points to more upside. A sharp rally is likely if the U.S. stock market weakens, and gold is still expected to be one of the year's top-performing assets. Bank of America and J.P. Morgan expect gold to surpass $4,000 per ounce by Q2 2026, supported by strong demand and macroeconomic factors. Mike McGlone is a seasoned senior commodity strategist at Bloomberg Intelligence. He explains that gold is driving the broader precious metals rally, with silver and platinum also benefiting. Gold is up about 40 to 45% this year, pushing ETF inflows to their highest since 2023 after years of outflows, while central bank buying remains strong. The $3,500 level has become key support. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. Ray Dalio has warned that U.S. markets are risking a hard attack due to massive debt burdens. He suggests gold be used as a protective asset, advising 10 to 15% portfolio allocations because gold tends to hold value when other asset classes falter. Risks include geopolitical shocks, U.S. stock market strength, and high interest rates, but gold appears to be anticipating a reversal in equities. A significant stock market downturn could trigger the next big surge, with support around $3,500 and potential corrections toward $3,300. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. We value your opinions.
They're all basically going up on the back of gold. Good example is silver. Silver and gold are both up about 45% on a one-year basis. Yet silver is known as the devil's metal for a reason. It's leveraged gold. It typically trades 2 times the volatility. On a risk-adjusted basis, it should be up 90%, but that's what's happened. Gold's pulling everything along with it, particularly platinum. In May, I think that gold-platinum ratio reached the highest ever, and platinum just kind of catching up as we're seeing that responsive buying. So everything's bottom line because of gold and because central banks are buying gold, and now ETF buyers are significant buyers of gold. The ETF total inflows have jumped up today as we speak on September 10th to the highest since 2023. It just got above that high from there then, and it's after 4 years outflows. There's a significant inflows into gold, central banks buying, and then everything I think about gold is just nothing but bullish. Obviously, that's kind of the fear when it's nothing but bullish. What stops it? And the way I like to phrase it is every time Mr. Trump speaks, gold smiles. And then, of course, there's those geopolitical things happening with wars escalating. I'm very concerned. So for now, as we speak, it's up 40% in the year about. The last time was up more than that was 1979. CPI was running 10%. Now it's below 3%. So the key thing I want to end with, Ivan, is just how we end this year. Right now, gold signaling there's major cracks in the global financial system, potentially major cracks in rapidly advancing risk assets. And I'm hoping we can get through this year without stock market volatility picking up just a little bit like it usually does. Yeah. And I think gold's anticipating that we're going to have some normal volatility pickup in the stock market. It can be very dicey. It's difficult, but I think as far as, first put some numbers on it. As we speak, it's gold's $3,653 an ounce. That old high at 3,500 is now support. Old high is now probably old resistance, probably now support. I think the next round level is 4,000. How much higher it goes, I don't know. But yeah, bull markets get stretched, insurance getting stretched. But the key thing is I just checked last week is you check for what's happening with the underlying market. First of all, what's happening with future speculators. Hedge funds are not way overweight long like they've been in the past, right? They're around 33% of total open interest. They've been as high as 45% of total interest net long. These are managed money net positions. And if you combine with gold ETFs, massive inflows, and there's a lot of room in gold ETFs. Just get back to the old highs. So massive inflows there, but it's a major shift. So I look at it as a pretty enduring bull market. If I were to buy it here, it'll go down 10%. That's just the way my life works. But I think as far as responsive investors, it's a bull market. I don't give investment advice, but I think the key thing to think about gold here is, here's a key risk, I think, for gold for the end of this year. Some significant détente out of Russia, Ukraine, potentially in the Middle East. The U.S. stock market stay on a tear, has to stay on a tear because it's a competition for gold. That's why we've had 4 years of outflow, stock market on a tear. Why buy the rock when stock's on a tear? And high U.S. interest rates. And to me, this is what gold's anticipating is a potential reversion in that very expensive U.S. stock market. The VIX right now, as we speak, is 14.66. The average for the year is 20. And it actually has been going higher. It's just very low right now because we're still somewhat in a summer doldrum period. So I think gold has a lot more room to the upside. I don't think it, on a significant correction, it might get near 3,300, but 3,500 is first support. I think the next round number resistance around 4,000. As far as timing, the bottom line for gold to really accelerate will be if the U.S. stock market rolls over. I should say when, because it's just when. I just hope it's in my lifetime. I think it's going to start this year. And that'll kick in the deflationary forces that you're seeing in China. And potentially maybe in Germany and a lot of the rest of the world's cutting rates because they see what's coming.
Mike McGlone expects gold to remain one of the best performing assets this year, though their call on treasuries has been wrong. Deutsche Bank analysts say margin debt has surged, and the current stock market environment shows parallels with the bubbles of 1999 and 2007. They warn that optimism may persist, but that a sharp correction could be coming. A banking research report emphasized that gold has crushed stocks, bonds, and even Bitcoin this year, suggesting that more investors are turning to gold as traditional risk assets look stretched. Mike McGlone predicts that signs of a recession are building as unemployment edges up, job growth slows, and payrolls are revised down. Global pressures, particularly deflation from China, add to risks. The U.S. stock market is historically expensive, and any reversal could spark volatility. Gold's strength signals cracks in the system, while long bonds may eventually become the next big trade if deflation takes hold. Let's shift our attention towards the interview.
The bottom line is no one wants to see the downturn. I'll start out with how I started the year. I still expect gold to be one of the best performing major assets this year. That's been working, knock on wood, and you got one right. And I fully expect Treasury bonds to be one of the best performing assets this year. I've been completely wrong there. This is from a guy who started in the Treasury bond pit in 1988. I thought I knew that market well. So nothing like markets to humble you. I've been wrong on Treasuries for 2 years. So I think what's going to happen, my fully anticipate, we're at the stage now. I've seen this. It's worse than it was in 99 and 2007 when stock markets go up and makes everybody get involved, and you have to keep, it's the pile-on factor. And I think at some point when it goes down, it's going to go down real fast initially, and then maybe stabilize because we're so overdue for just hitting some stops like copper did. Copper dropped 20% in a few hours because it got too expensive for silly reasons, and then just runs through things. So I'm afraid the stock market's going to do that. I don't know what the trigger is going to be, but there's certain times you're supposed to be selling when they're yelling. There's this massive yelling in the market, particularly in cryptos, which I see the most froth. And I just been pointing out that Bitcoin to gold ratio has been flat for 4 years. S&P 500 total return has been flat versus gold. It's been unchanged versus gold for 8 years. The Bloomberg Galaxy Crypto Index has been unchanged versus gold for about 8 years. And gold beats everything. If the rock's beating these assets, there's an indication that you probably should be overweight the rock and underweight highly volatile speculative risk assets that are most expensive by some measures in history. Well, inflation was much higher in 2007 and early 8 when the Fed started cutting rates because of cracks in the financial system. The bottom line is unemployment rate is ticking higher, jobs are ticking lower in all measures, not just the government data, which is somewhat dicey now. because of what Trump did by firing the BLS leader is, but ADP data is negative. Employment claims from the states are all tilting downward. So I think that's part of the recession that's kicking in. Now, of course, we've had this significant downward revisions in payrolls, and people have heard this from people like me before that, yeah, I was looking for a recession. My economics team was thinking next recession almost 2 years ago. It didn't happen. It's the delayed reaction that I'm most concerned about, particularly as we have a major discombobulating force, most in my lifetime, of Mr. Trump hitting hard on tariffs in the rest of the world. I mean, this has shifted the post-World War II order. So the rest of the world's seeing that, particularly in China. And you started with yields, and right now as we speak, that 10-year note yield's at 4.06%. The high was around 4.80 on the year. Just a week ago, the high in the 10 and 30-year was 5%. And I think the guide to look to where U.S. yields are going is look over at China, second largest economy. Its 10-year note yield right now is 1.82%. Severe deflationary forces in that country, and they're trying to export that deflation to the rest of the world, partly because they can't export it to U.S. anymore as much. So I think we're heading towards a normal recession. And the bottom line for everything is none of this stuff that I just said to you really matters until the U.S. stock market starts backing up. Because right now we're at almost 2.3 times GDP, market cap to GDP, about $70 trillion. And GDP is 30, maybe a little bit above that. That's the most on an end-of-year basis since 1929, when Herbert Hoover was elected. So I'm afraid that Mr. Trump might just have the disadvantage of poor timing. The stock market's so expensive. We're looking for normal reversions there. And I've seen the indications from gold, certainly gold outperforming most risk assets like Bitcoin and the stock market. And I think the next big trade will be indicative of is what gold's anticipating, normal deflation. I said deflation from inflation, which is normal. And that's why I think U.S. long bonds might end up being some of the next big trade. The bottom line for that is U.S. stock market has to go down a little bit, volatility pick up, and I'm prepared to get stopped out on that call by the end of the year if that doesn't happen.
Could a sharp downturn in U.S. equities be the catalyst that drives gold decisively above $4,000? With central banks steadily buying, how much higher can gold's floor realistically rise in the coming years? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to 2% of it, silver would be $70 or so. But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro-technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor, the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then, but 10 years it's been net lateral. Well, why is gold not net lateral? It's 1.5. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but you hit those trigger numbers, that could suddenly become an off the sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because the financial institutions are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, wet bar soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000, you would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before the same dimension move. You go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.